Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first, Visa and Mastercard's Agentic commerce revolutionizes shopping with AI agents, but shatters the existing consumer liability framework. We'll explore how this new AI shopping model could transform liability frameworks and what it signals for the future of e-commerce. Second, UK courts £1.5 billion ruling against Apple's App Store sets a new 17.5% fair rate, challenging the 30% commission standard across tech. We'll analyse why this court-endorsed fair rate is a turning point and how it could affect the commission models of other digital platforms. Third, an $8.9 billion lawsuit reveals the AI energy crisis as a US utility sues to save wind farms needed to power Virginia's data center alley. This discussion will reveal how this legal battle connects to the larger AI energy crisis and what it means for private investment in critical infrastructure. Fourth, Korea's $15 billion cultural wave faces collapse as talent drains to streamers and US firms profit by de-territorializing the K-pop brand. In this episode, we'll break down this critical de-territorialization trend and what it signals for national cultural industries competing against global streaming platforms. Fifth, SoftBank's rumoured $108 billion acquisition of DigitalBridge signals a massive pivot to control the physical picks and shovels of the AI industry. Today, we'll take a closer look at this massive buy versus build strategy and its implications for the geopolitical competition to control AI's physical foundation. The way you shop is about to be completely revolutionized, and the world's biggest payment giants are building the system right now. It's a concept called Agentic commerce, and executives say it could be more transformative than the rise of Amazon. Imagine telling an AI, find me the cheapest flight to Tokyo under $500. And it doesn't just give you options, it finds the flight, books it, and pays for it, all within the chat. So the thing is, this isn't just a smarter search engine. This is about giving an AI agent delegated authority. You're not just asking it for information, you're giving it permission to act and spend money on your behalf. That's the revolutionary leap. This isn't a distant future. Visa and Mastercard have already completed pilot programs, and executives say the technology will become a reality as early as the first quarter of 2026. Now, get this. To make this work securely, Visa is developing something called the Trusted Agent Protocol, or TAP. Think of it as a digital passport for your AI agent. It uses special cryptographic signatures to prove to a merchant's website that your AI is legitimate, that it's really you who sent it, and that it's authorized to make a specific purchase. It's a system designed to separate the good AIs from the malicious bots. As one Mastercard executive put it, we've gone from cash to digital, now we're going from digital to intelligent, and the numbers are staggering. A study from Adobe found that AI-driven traffic to US retail sites has already increased by a jaw-dropping 4,700% in just 1 year. That massive surge is exactly why these new security protocols are so critical. Without a way to verify them, billions of AI agent requests could look like a massive cyber attack to retailers. This new system is being built to manage that tidal wave of automated traffic. But this is where the situation takes a more complex turn. What happens when the AI makes a mistake, buys the wrong product, or books a hotel for the wrong night? A Visa executive went on the record saying, you almost have to assume mistakes will happen and create guardrails. For decades, a credit card dispute has involved four parties: you, the consumer, your bank, the merchant's bank, and the merchant. Now, Agentic commerce inserts a fifth player into that chain, the AI agent. This shatters the entire liability model. If your AI buys the wrong thing, who's at fault? You for giving the command, the AI developer for its flawed code, the merchant for a confusing website. Legal frameworks are not built for this, and it's creating a massive unresolved question of accountability. This all leads to a massive power struggle. Merchants are facing intense pressure as AI agents will give consumers the power of perfect price discovery. It could signal the death of the digital storefront as we know it. When a dispassionate algorithm is your shopper, prioritizing price and specs, what happens to brand loyalty, clever marketing, or the impulse buy? Companies are realizing they may soon have to market their products not to you, but to the AI itself by optimizing their data so the algorithm picks them. In a sign of the coming battle, Amazon has already started testing its own buying agent while working to block external AI agents from crawling its website. When we place Amazon's current strategy alongside the history of online travel, the parallel becomes clear. It's almost identical to the conflict between airlines and online travel agencies like Expedia and Kayak in the early days of the internet. Airlines tried to block them to keep control over their customers and pricing. What we're seeing with Amazon is the first shot in a new platform war, a battle over who owns the customer relationship in the age of AI. And this isn't just a US phenomenon. The major players mentioned are American, but other global powers are not standing still. The European Union and China are already moving to build their own sovereign agentic commerce systems. They want to avoid dependency on US tech and enforce their own local regulations like data privacy laws. This is escalating from a business shift to a matter of digital and economic sovereignty. The challenges are immense, from security to liability. But according to the payment companies driving this change, the shift is unavoidable. The final word from a Visa executive is that when it comes to this technology scaling, we are likely talking months rather than years. Speaking of powerful platforms setting the rules, a legal storm is gathering over big tech, and the price tag is a staggering £6 billion. The first bombshell is a landmark £1.5 billion ruling against Apple, finding the company overcharged millions of UK customers for years. The core of the issue is the up to 30% commission, what campaigners have branded the Apple tax on App Store purchases. We've talked about Apple's malicious compliance playbook before, and this UK case lands right in the middle of that global tug-of-war. But what really brought this to a head wasn't just the ruling itself. The court didn't just say 30% was too high, they actually set a new benchmark. Based on expert analysis of Apple's massive profit margins, which were reported to be as high as 78% for the App Store in 1 year, the tribunal suggested what a fair rate would be. They landed on 17.5% for app sales and just 10% for in-app purchases. This is huge because it's a court putting a specific number on what it considers fair, challenging the entire industry's pricing model. The case represents 36 million UK consumers, and if Apple's appeal fails, every person in the UK who made an App Store purchase between 2015 and 2024 could be entitled to a payout. This is possible because of a relatively new legal weapon in the UK, the opt-out class action system. Unlike in the US, where you often have to actively opt in to join a lawsuit, this system automatically includes everyone affected unless they specifically choose to leave. It's a game changer for consumer rights. And as of last year, the total value of these kinds of claims in the UK was over £122 billion. The battle is escalating beyond just this one case. Consumers, small businesses, and entrepreneurs are demanding a combined total of over £6 billion from both Apple and Google, alleging breaches of competition law. One academic who won the case against Apple called it a tidal shift against big tech. While activists are fired up, surveys show the public is actually pretty split. For example, one study found that while about a third of people support more regulation, another third are against it. However, another study found something interesting. 28% of iPhone users would be extremely likely to buy apps directly from a developer's website if it saved them money. So while not everyone is paying attention to commission rates, a significant chunk of consumers are ready to change their behavior for a better price. In the largest single claim, the consumer group, which announced a £3 billion case against Apple over its iCloud services, claiming the company is trapping customers. Lawsuits are also targeting Google's Play Store, accusing it of charging excessive, arbitrary, and discriminatory commissions against developers. This legal battle is sending shockwaves through other walled garden ecosystems. Think about video game consoles like the PlayStation or Xbox. They've operated on a similar 30% commission model for years. If these lawsuits against Apple and Google succeed, it sets a powerful legal precedent that could be used to challenge the fee structures across the entire gaming and digital content world. For their part, Apple and Google are fighting back hard. Apple says the claims are unfounded and that the court took a flawed view of a thriving and competitive app economy. Google argues these cases seek to upend a system that has actually lowered prices and increased choice for consumers. What we're seeing is a fascinating clash of global strategies. The UK is using this court-led consumer compensation approach. Meanwhile, the European Union is using proactive regulation like its Digital Markets Act. And in the US, the Department of Justice is taking the antitrust litigation route. This creates a complex and fragmented global landscape for these companies, who are now fighting different legal battles on multiple fronts. We've called it an iOS splinternet before, and this ruling deepens that regulatory patchwork. This is more than just a legal dispute over App Store fees. It's a direct challenge to the financial architecture of the world's most powerful tech companies, with billions on the line and a consumer-led rebellion that is gaining undeniable momentum. From a legal fight over digital commissions, we now turn to a legal bombshell in the US that connects the future of artificial intelligence to a high-stakes political battle. Dominion Energy, a major utility, is suing the Trump administration after it ordered a sudden stop to 5 massive offshore wind farms already under construction. This isn't a small dispute. Dominion has already spent a staggering $8.9 billion on just one of those projects. The Coastal Virginia offshore wind farm. Now, when a project this massive gets delayed, the costs don't just disappear. The interest on that money, inflation, and rising material costs all add up. The big question is, who pays for it? These costs are often passed directly onto consumers through rate increases. In fact, Dominion has already proposed rate hikes for its Virginia customers. If this project gets cancelled entirely, a state commission will have to decide if the billions already spent are a loss for the company's shareholders or a bill that lands on the ratepayers. The company's reason is explosive. In a direct statement, Dominion said, "Virginia needs every electron we can get as our demand for electricity doubles. These electrons will power the data centers that will win the AI race." We previously highlighted why Virginia is ground zero here. Data centers in the state now consume about 60% of all the electricity used by households statewide, and the utility has mapped out more than $50 billion in new infrastructure. What Dominion is saying isn't an exaggeration. Actually, the AI revolution is creating an energy crisis. Goldman Sachs research predicts that global power demand just from data centers will increase by a staggering 165% by 2030. The International Energy Agency says it will more than double. The situation is critical because simply connecting new load to the grid can take close to a decade in some regions. That's right, a fight over wind turbines is now a fight over the future of AI. The lawsuit calls the government's stop work order unlawful, arbitrary and capricious, and argues it threatens the energy supply for Virginia's data center alley, the largest concentration of data centers in the world. Now, that legal term, arbitrary and capricious, is important. It means a decision was made without reasonable grounds. The repeated use of these orders, only to have them struck down in court, has led some experts to suggest this could be a deliberate strategy of delay by litigation using the legal process itself to create so much uncertainty that a project dies. The Department of the Interior cited newly identified national security risks and concerns about radar interference, ordering a 90-day pause on the projects. But if you look closer at that radar claim, the justification starts to look a bit shaky. Wind turbines can indeed interfere with some radar systems, but this is a known issue. Believe it or not, other NATO countries like the United Kingdom and Denmark have been operating massive offshore wind farms for years, and they've already developed solutions. The US Department of Energy has actually been working with the Department of Defense on these very same mitigation strategies. National security expert and former commander of the USS Colkirk Lippold publicly questioned that reasoning, asking, "I want to know what's changed. To my knowledge, nothing has changed in the threat environment that would drive us to stop any offshore wind programs." And this isn't a one-off fight. Similar stop work orders on wind farms off New York and Rhode Island were previously lifted by a judge, only to be suspended again. An $11.2 billion project, which broke ground in 2024, is now frozen. The fallout from this battle goes far beyond just these wind farms. It creates something investors call sovereign risk. It sends a signal to private companies around the world that even if you follow all the rules, a future administration can kill your multi-billion-dollar project with an executive order. This kind of political uncertainty has a massive chilling effect on investment. In fact, due to policy uncertainty, over $14 billion in clean energy investments were already cancelled or delayed in the US in 2025. While the US grapples with the physical infrastructure for its tech future, another national powerhouse is facing a crisis in its most famous export, culture. A top Korean film director just went on the record with a 2-word warning about the country's movie industry almost collapsed. Despite a record-breaking $15 billion in cultural exports, the engine of the Korean wave is sputtering. Cinema admissions have plummeted 45% since 2019. Box office revenue has cratered from $1.3 billion to just $812 million. The situation is so dire that major distributors are expected to slash their local film releases in half next year. This isn't just about empty theatres. The real crisis is a talent drain. Directors and top talent are migrating from the traditional Korean film industry to global streaming platforms. Why? Because a streamer like Netflix can offer bigger budgets, more creative freedom, and a global audience overnight. This is hollowing out the crucial mid-budget film sector, which has always been the training ground for the next generation of great Korean directors. And this isn't just a movie problem. The crisis is hitting K-pop too. For the first time in a decade, physical album sales are in a freefall, dropping nearly 20% in just 1 year. In response, major agencies are ditching the quest for mass appeal. They're pivoting hard, focusing on massive global tours and catering exclusively to what they call a core fandom that will spend big money. This pivot, by the way, is powered by an incredible tech ecosystem. We're talking about platforms like Weverse, which is basically a one-stop shop for superfans, combining social media, exclusive content, and a massive online store. As of late 2024, it had nearly 10 million monthly active users. This strategy is a goldmine, but a very specific one that prioritizes guaranteed profit over creating the next universally known group like BTS or Blackpink. Here's where it gets interesting. As Korea's creative industries focus inward, global players are moving in. The situation presents a fascinating duality. Korea once beat Hollywood at its own game, but now it's as though Hollywood is beating Korea at its own game. The prime example is Netflix's animated smash hit K-pop Demon Hunters. It used Korean aesthetics to become a global phenomenon, but it was an American production. This reveals a huge vulnerability that experts call de-territorialization. It means K-pop has become so globally popular that its style is now a kind of open source template that anyone can use. The Koreanness becomes a portable aesthetic that no longer requires a Korean company to profit from it. The Korea Chamber of Commerce and Industry projects that the intellectual property value of K-pop Demon Hunters could reach $1 trillion, but the actual revenue is flowing to American platforms and Japanese production companies. It's the same trap Japan fell into with anime, where the global spread diluted domestic control and profits. The South Korean government is now scrambling, launching a massive $51 trillion cultural investment plan. This top-down approach, however, carries a huge risk. By pouring money into the system, governments often end up funding safe bets from established players, which can accidentally stifle the very grassroots experimentation that leads to true innovation. In fact, reports show that a huge chunk of Korea's previous K-content funds, over $1 trillion, has gone unspent, pointing to major bureaucratic hurdles. So while the industry will likely keep making money from its most dedicated fans, the era of Korea producing culture-defining global hits that win over the entire world may be coming to an end. From a crisis of cultural investment in Korea, we pivot to a bombshell report about a deal that could reshape the entire AI industry. A company's stock just exploded by as much as 50% in pre-market trading. The company is DigitalBridge, a data center investment firm, and the report claims Japanese giant SoftBank is in advanced talks to acquire it. Interestingly enough, the term investment firm is key here. SoftBank isn't just buying a data center operator. They're buying the acquirer. DigitalBridge is a company whose entire business is finding, buying, and managing digital infrastructure assets. By acquiring them, SoftBank gets a pre-built expert team to help them scale their physical AI footprint much faster. This isn't a minor deal. DigitalBridge manages a staggering $108 billion in assets, meaning this is a massive move to control the physical infrastructure that underpins AI applications. However, if you zoom out, you'll see another layer of strategy at play. This is what experts call a picks and shovels play. Think about the gold rush. Sure, some miners struck it rich, but the people who consistently made fortunes were the ones selling the picks and shovels. In today's AI gold rush, the gold is the AI models. The picks and shovels are the data centers and fiber networks. SoftBank is betting that the long-term value lies in controlling this physical infrastructure. And the market potential is mind-boggling, with projections suggesting AI-related infrastructure investments could hit $6.7 trillion by 2030. But that's not the whole picture. The real turning point in SoftBank's strategy is what they did just before this. The Japanese giant recently sold its entire stake in the chipmaker Nvidia for $5.83 billion. They cashed out of one of the hottest AI stocks, and reports indicate it was to make room for an investment in OpenAI. Now, with this move on DigitalBridge, the full picture is coming into focus. We are likely seeing the creation of a vertically integrated AI ecosystem. Step 1, sell a chip stock to free up billions. Step 2, use that cash to partner with a leading AI developer like OpenAI. Step 3, acquire a massive portfolio of data centers through DigitalBridge. This gives SoftBank the ability to provide dedicated, cost-advantaged computing power to its key AI partners, creating a powerful, self-contained loop. This strategy sets up a fascinating clash of titans. We're seeing hyperscalers like Microsoft and Google in a build phase, spending tens of billions to construct their own data centers. At the same time, SoftBank is taking a completely different path with a buy approach. They're acquiring a ready-made empire, which could give them a massive head start in pure capacity. It's a different path in the same race, competing directly with other major investors like Blackstone. While the deal could be announced any day, both SoftBank and DigitalBridge have declined to comment, fueling speculation about the final details. This decision, however, brings both massive opportunity and comes with inherent geopolitical risks. A deal of this magnitude isn't just about money. When a foreign company tries to acquire a firm that owns critical American digital infrastructure, it can trigger intense national security reviews from bodies like the Committee on Foreign Investment in the United States, or CFIUS. In an era of AI sovereignty, where nations want to control the infrastructure powering their digital future, foreign ownership of data centers is an incredibly sensitive issue. This adds a fresh layer of uncertainty to the whole deal. This isn't just another acquisition, it's a calculated multi-billion-dollar play for the foundation of the entire AI industry. While others focus on the code, SoftBank is making a power play to control the physical world where that code lives.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.